going to focus for the next 20 minutes on the financial impact and policy coverage issues. Please join me in welcoming Commissioner Scott White from Virginia and chair of NAIC's Financial Condition Committee, most commonly referred to as E Committee, and Sean Kevelighan, and Michel Leonard from the Insurance Information Institute, or TripleI. Commissioner White.
All right. Thanks you, Mr. President. I think to begin this segment on financial impact, it might be helpful to take a moment and reflect on where we stand with COVID-19 here on March 20th. Everybody's reading about the sharp spike of cases in the last few days, which I think reflects both the rapid spread of the virus, but also the fact that more people are being treated. The concern is that everyone is focused on the potential that the healthcare system could be overwhelmed by the flood of cases occurring all at once. What everyone is hoping is that by taking certain measures now in the way of social distancing, that we'll be able to flatten the curve, so to speak, and then slow the spread so that it becomes more manageable. Of course, these practices, I think we all agree, are necessary. They definitely cause great disruption to the economy, at least in the short term. And the fact that we don't know whether these measures will be enough to, flatten the curve, I think is causing a great deal of uncertainty. And this uncertainty is going to have an impact, as we've already seen, not only on the health of the country, but on the financial of the insurance industry. So how much and for how long a period? This is what we're going to be closely monitoring in the days, weeks, and months ahead. So to the extent the flattening does occur, as we all hope, I think it's reasonable to say that there will be very few, if any, immediate solvency issues for the industry. The question is what happens if the flattening does not occur in the near term. Again, we're going to be faced with a situation where the healthcare system could be overrun with patients. And if you look for comparison purposes, if this was to go on as long as the Spanish flu, and if you recall that started in the spring of 1918 and lasted over 2 years, I think it's likely that some of the smaller health insurers will be financially stressed, perhaps even become insolvent, particularly if you focus on an area where they provide coverage that's hit very hard with hospitalizations. So it is very sobering. But the fact is a pandemic of this, the magnitude of the Spanish flu, where you have millions of Americans hospitalized, that would have a financial impact, a severe one, there's no question. So really the question is, what's our best guess as to what might occur? And if you look at modeling conducted by the Society of Actuaries, for example, or various other parties, along with our own general understanding of the insurer's business profiles and their coverage terms, I think we can make a couple of predictions. First of all, I think it's likely, though we can't say for certain, that the larger, more highly capitalized health companies that write a great deal of coverage in the United States, they would likely survive even under a pandemic of the size we've been talking about. I think we can say it's likely that the weakest carriers, regardless of which sector, would be the ones where we might expect to have a little bit of trouble. I should emphasize that this analysis is basically largely on the impact from a claims perspective, and it's not really taken into account the potential impact on insurers from the financial market side, the asset values, as we say. This is where we get into all the uncertainty roiling the financial markets that we've seen over the past 2 or 3 weeks. I will say that with recent aggressive policy moves made by Congress, the Treasury Department and the Federal Reserve, it does appear that the turmoil we've seen in the financial markets may be subsiding somewhat. But setting aside the potential claim implications, declining asset values, I think it's important to emphasize to everyone here the current financial strength and resiliency of the industry as a whole. More specifically, all 3 sectors of the industries hold plenty of cash, marketable securities that I think are more than enough to pay claims, even under a Spanish flu type scenario. So we don't think they would be forced to liquidate assets whose value may be depressed for some period. Apart from a small number of well-capitalized property and casualty companies, the industry's exposure to equity securities is really pretty small. For example, if you look at the life insurance industry, they hold less than 5% of their investments in publicly traded equities. Finally, the industry overall has 95% of its bonds, which are far and away its greatest asset class, in very high quality investment grade securities, which are less likely to default during a weakened economy. So, again, in saying this, I don't want to create the impression that the industry won't experience some capital losses on its investments. That is bound to occur. However, state financial regulators, as well as the NAIC, we're going to be closely monitoring these companies, the ones that have the greatest exposure to the commercial sectors with the potential to be hit the hardest. So here we're talking about, as most of you can guess, the oil, the travel, retail sectors, things of that nature. Last thing I'm going to mention, this is an issue that may not be of immediate concern, but we do think it's going to be a long-term issue. And that's the further drop in interest rates, giving us more interest rate risk to deal with as we move forward. We do think this is going to have a negative impact on the earnings of the industry. This will likely put more pressure on insurance companies to invest more aggressively and in more complex securities. So in addition to monitoring claims experience of our health insurers and those insurers that have more investments in certain economic sectors, we're going to be working closely with life insurers to better understand both the short-term and the long-term impact of the extraordinary rate environment that we now face. So, Mr. President, that is a general overview of our early assessment of the impact on the industry's solvency position. At this time, I'd like to turn over things back to you to introduce the gentleman from the Big I, Big TripleI.
That too. Okay. Obviously, as we said earlier, we have Sean Kevelighan and Michel Leonard from TripleI. So, gentlemen, which would like to go first? Mr. Kevelighan.
Yes, thank you, President Farmer, and good to see you again, and appreciate you having us here today. On behalf of Dr. Michel, Leonard, and the entire TripleI team, all of whom are working hard to fulfill our mission of being a trusted source of information and insights about insurance, we truly appreciate the NAIC's invitation to address you here today. This year marks TripleI's 60th anniversary. We're proud to be able to report before this forum that the property casualty insurance industry is well positioned to honor our promises it has made based on strong fundamentals, which include long-term enterprise risk management and an actuarially sound approach to underwriting. Today's industry stability can also be attributed to this regulatory community working hand in hand with our industry over many years to ensure we agree on the appropriate governance and management standards that allow us to plan, respond, and weather through these disruptive times. It is important to appreciate, much as this is a catastrophe of historic magnitude, that there are more on the horizon: hurricanes, wildfires, floods, and others. And we must remain prepared in the way that we have long planned. So again, we can continue to act as the financial first responder we have been for centuries. I'll ask if we can move into our first slide. And just wanted to focus first on some key points that we'll discuss here today, and then I'll turn it over to Michel, who will provide the economic context. First, we have a near $800 billion policyholder surplus, which is on hand to ensure we can keep those specific promises we made to policyholders. Second, our diverse investment portfolios, which rely a majority on less volatile fixed investments, which was raised earlier, focus on long-term stability. Third, the well-capitalized global reinsurance market provides further stability for U.S. exposure. Fourth, business interruption coverage, as a result of learning from history and the challenges of underwriting such unpredictable incidents like a pandemic, has minimal exposure. And finally, should the highly unlikely event of an insurer becoming insolvent occur, the state guarantee fund system is in place to further ensure our promises are kept. Please allow me to introduce TripleI Senior Economist, Dr. Michel Leonard, who will brief us on the coronavirus's likely impact on the U.S. property casualty insurance market.
Thank you very much, Sean, Director Farmer, and good afternoon, everyone. Actually, good afternoon from upstate New York. So I'll go into an overview of the industry performance then go into the economic background to those assumptions, and spend the bulk of my time discussing line-by-line assessment of COVID-19 impact for P&C lines. Now, the first slide, which we would look at, we should be on slide number 3, by the way, is key sources of P&C insured profits. Keyword is stable. Profit and the industry as a whole is stable. If we're looking at net investment gains, it is stable at around 50 billion. And if we are looking at underwriting gains and losses, it is also stable around 5 or 6 billion. And you can see these numbers have been stable for since 2018. And these are the most recent official numbers are Q3 of 2019. So some of the numbers need to be adjusted for since then. But certainly, one should assume that the trends do continue based on what we've been able to ascertain. Next slide. I'd like to speak a bit about the portfolio allocation. As Commissioner said previously, keyword of the way the insurance industry manages its portfolio allocation is prudent. We have had and continue to have a conservative distribution of 69%, approximately 69% to bonds, 21% to equity, and about 13% to others. Now, the key element here is that it's always been conservative. It's always been sound, prudent management, even when the industry did seek return and extend its exposure, increase its exposure. At the peak, the exposure to bond was 21%. And that started shifting back to safe haven type investments, low risk investments, starting in 2017, 2018, and the first signs of market before we started getting into the COVID situation. Now, as a result of sound underwriting and prudent investments, this means that the industry has an adequate amount of surplus. It also means that we have an adequate amount of loss reserves. That is where we've been, that is where we expect to be, and that is where we expect to continue to be. Now, what's important here is that these surpluses and reserves ensure that the industry can address any spike in claims under existing policy terms. So while we have the surplus and the reserve that are expected of us, and we continue to do so, it's important to understand that those serve a current purpose in maintaining the health of the industry and our ability to perform and pay claims under existing policies. I'd like to speak a bit here about the global macro background to our assessment first of the industry and its stability, financially speaking, and then moving into the lines. Now, we've come up with two global and a US GDP growth forecast. We have tended to be more conservative than consensus. By that, I mean that we've tended to have a view that growth will reduce slightly more than is currently expected, though I have to say consensus has been moving in our direction. And currently we see that global growth would decrease from 2.9% down to 2.9% from 3.3, down about half a point. And domestically, it's a bit more severe, from 2.3% to 1.5%. These are numbers for 2020 compared to 2019. Now, a lot of economists were expecting to slow down this year. A lot of economists were expecting it to slow down. It started really last quarter of last year, would catch up by the end of this year, would be in a quote recovery after a weak slowdown going into next year. That's unlikely to happen now because of COVID. And we're not talking about an impact just for right now for spring and the summer. We're really looking at a correction in terms of growth, reduction in terms of growth going into the third and the fourth quarter of this year. And that would mean that the recovery, any expectation of a recovery would go from 2021 into 2022. Also, just as to mention, the assumption behind this is that we have about 240 to 400,000 cases worldwide, and a death rate based on those worldwide cases, but those are expectations and infection. I'd like now to move to the core slides of this presentation, which have to do with the expected impact that COVID-19 may have on different lines within the P&C sector, the P&C industry. We're going to go from the highest to the moderate to the lowest, and then we'll discuss a bit on their own specialty lines. Now, this is by no means a rating system. This is really a way to try to communicate how it may impact different lines and where the bulk of the impact may be, all things being equal. Workers' comp will likely have the highest, excuse me, will likely have the highest impact because of the nature of the pandemic and the fact. Specifically within that, we foresee that carriers providing coverage to medical professionals and to first responders for self-explanatory reasons. They are right there in the front lines and so forth as part of their job, so it meets job requirements and so forth. But as well as transportation and retail. Now, retail may change a bit because of some of the California decisions. For example, we've seen the city of New York State, reductions on retail being able to operate and so forth. But certainly, medical professions, first responders, transportation, and retail. When putting this presentation together, we were asked by our colleagues at NAIC to look at areas, gray areas, areas of concerns, areas for further clarity, education, communication. This is what we do at TripleI with regards to folks understanding the coverages, ensuring adequate performance, and so forth. So we looked at some areas within workers' comp of the need to clarify that the source of infection for the policy to perform needs to be directly related to work. That's a very key element. It's very difficult, of course, to demonstrate in the context of an epidemic of the virus. Need to remind employers that they have exposure for workers working from home, even though they may not control the work environment. So that does increase the likelihood of exposure because of the lack of control of the environment. And then also it's important to remember that, as with many coverages, workers' comp coverages do vary significantly across states. Next slide. Just for keeping track purposes, we should be on slide number 8. So moving from the highest impact, again, all things being equal, to lines that we believe we expect to be moderately impacted, we'd be looking at general liability and directors and officers. For these lines, as I was saying previously, we look at which specific industry exposure or area of activity exposure. So carriers that offer coverage to healthcare and pharma. Again, I would say self-explanatory given the nature of the profession and the area of activity. Entertainment, transportation, and retail. Those areas, though, as with retail in the past, also a little less so if there are large-scale actions to curtail activities and so forth, and to a lesser degree manufacturing, as much as one would expect, but certainly it's important to note. Potential gray areas are areas that we need to communicate about. Who is responsible for providing protective gear equipment? Key issue. Best practices in how to apply national health guidelines to specific situations. Given the specifics of, let's say, a university workplace or a hospital and so forth. And then the need for disclosures. And this is really something that has to do with publicly traded companies. But again, ensuring that proper disclosure of risk take place. All of this in the context of clarity surrounding. Next slide. Lowest impact, and I hesitated many times using color green because there's nothing happy about any of these conversations. So this is not looking for the silver lining, this is simply for looking at areas where there might be less of an impact than other lines. We expect property carriers to experience lower impact simply because of the requirement that there be physical damage. And that said, though, there are some loss of use carrier riders that may rise to claims that department, but certainly overall, because of that requirement, general property should have some of the least increases in exposures. And then auto, as is traditionally the case, lower economic activity, less transportation, less movement of goods and people, and so forth, as we see in any recession, and that would mean less opportunities for accidents, collisions, and so forth. This will be my last slide before passing back to Sean. But in terms of specialty lines, now there's been a lot of conversation about business interruption, and we do want to make clear that the way policies and business interruption, supply chain interruption, and so forth are structures, we don't see significant increases in losses. We don't see certainly losses becoming threatening the stability that the industry is benefiting from in terms of this we've been discussing. And that's because of high deductibles, waiting periods, and some of the physical requirements as well in the BI. Now, it's a less the case for travel insurance and for some of these event cancellation, but the extent of that coverage is much lower. So there again, the frequency may be a bit higher in terms of claims for event cancellation, travel insurance. The severity of them in terms of, again, the overall well-capitalization of the industry would not give rise to concerns in that area. Cyber risk, just one last thing, cyber risk. It is important to communicate that cyber risk does increase with the likelihood with folks working from home. So that is an element, again, in terms of communication that we are making sure to let folks know about. That's the end of my part of the presentation. I'll pass back to Sean. Thank you very much, everyone.
Thank you, Michel, and appreciate that. One thing we were also asked is to get some feedback from TripleI supporting members. Our members represent approximately 65% of the total premiums written in the property casualty market. And as you might imagine, their first and foremost concern is about their employees. So they are working with their employees to better understand and establish a safe working environment like all of us are here today. And they remain, and so the employees that can then shift and remain focused on the customer. And as for making sure the customer needs are being met, there's also a need to ensure clarifications and what's covered and what's not. And so there's a lot of communication. We are doing that at the TripleI just to make sure that people are informed and understood. We are seeing some confusion with business interruption, where again, the industry has learned that pandemics simply cannot be underwritten in a way that the customer is willing to purchase, so it's mostly excluded. Finally, and unfortunately, and perhaps a sign of our times, there's a likelihood for lawsuits to surface should there be misinterpretations of coverage. We have seen a significant uptick in litigation-related losses in recent years, so our members continue to be concerned about the rising costs associated with social inflation. So just to get to our last slide and close out, I'd like to make sure I point out and make the point about TripleI and how we were founded to remain supported by the industry to be a trusted source of information so that customers are empowered to make educated decisions, manage risk, and appreciate the essential value of insurance. We neither lobby nor sell insurance. The TripleI provides objective, fact-based insurance resources that are rooted in economic and actuarial soundness. Our organization is an example of the unique and special ways insurance defines success. Another important way we define success is what I mentioned earlier, keeping the promises we've made to customers. That is why we have such stable positioning. In closing, I should remind you all that the TripleI is continually releasing new and updated information related to the coronavirus. We invite you to continue to visit our website for more information, iii.org, and or contact us directly. And with that, I'd like to thank you for the time and happy to take any questions.
Thank you, Mr. Kevelighan, Dr. Leonard, and Commissioner White. We have time for one question. Let's see if there might be a commissioner with a question on his or her mind. Mike or Andy, do you have another question standing by?
Thanks, Director. We have a number of questions. I think focused a lot on the business, a number focused on the business interruption coverage and potentially sort of the financial results around that. I think a lot relate to the issue of whether or not BI will cover a pandemic-like event.
Yeah, thanks, Mike. I really appreciate it. You know, it's important, again, you look at, and we've seen here today, models and how complex models around pandemics can be, and almost in parallel, you could parallel this to terrorism, but a pandemic is even on a greater scale, right? And so in terrorism, you generally are restricted to a certain economic area or municipality like we saw as a result of 9/11 in New York and DC. This event that we're talking about is in all of our states and jurisdictions, right? So it's at a magnitude of a much larger scale. And the current way that insurance has been modeled and why, frankly, we're in a stable place is because we're unable to underwrite that risk again in a way that policyholders would be able to purchase it. So that's where we are today. I think it's important to continue the conversation of what the future looks like, but I would exercise caution in any efforts to look back and be retrospective on this because, again, we have more catastrophes to come here, natural and man-made. And the way that our businesses are set up, the way that we work the way the industry, I should say, has worked with the regulatory community on enterprise risk management needs to be maintained. But as we have in the past, I think the industry is absolutely wanting to work with the regulatory community and make sure that we're being consistent and working together through this crisis, which we're still right in the midst of. So we don't want to jump into something that could have long-term impact while we're still trying to maintain what we're doing right now and handling the catastrophes that are here today and are going to come inevitably tomorrow.
Okay, thanks. Without a doubt, on the property casualty side here in our state, it's the business interruption issue. But thanks again for that great discussion. And I know the three of you will continue to work on these issues and will providing us all with updates as this health crisis continues. So thanks again.